Here's something most people have never considered. The last time you applied for a credit card, a loan, or a mortgage, the decision was almost certainly made by a machine. Not assisted by a machine, made by one. A human might have been sitting across the desk from you, smiling, asking about your job, nodding at your answers, but that human was performing a role that had already been hollowed out. The algorithm had decided before you sat down. The conversation was theater. This is not new. This has been true at most major financial institutions for years, and yet most people still walk into banks believing a person is evaluating their character, their story, their potential. That gap between what people believe about how finance works and how it actually works is about to become the most consequential misunderstanding of the next decade. Because what happened to loan officers is about to happen to financial advisors, portfolio managers, insurance underwriters, tax strategists, compliance officers, and eventually the executives who oversee all of them. Not slowly, not in some distant future we can prepare for at our leisure. The infrastructure is being built right now, and the speed at which it's moving is something the industry itself is struggling to comprehend. Let me show you what I mean by going deep on one specific transformation, because I think it reveals everything you need to understand about where all of this is heading. In the year 2000, Goldman Sachs employed 600 traders on its U.S. cash equities trading desk in New York. These were elite professionals, people with mathematics degrees from MIT, MBAs from Wharton, years of apprenticeship learning to read markets, manage risk, and execute trades worth hundreds of millions of dollars. 600 of them, working one of the most prestigious desks in global finance. By 2017, there were two. Two human equity traders remained. The rest of the work, all of it, had been absorbed by automated trading systems that Goldman had spent over a decade developing. Most people hear that story and think it's about job loss. It's not. Or at least, that's not the interesting part. The interesting part is what happened to the quality of the work. Goldman's automated systems didn't just do the same job cheaper. They did it better. Measurably, dramatically better. Execution costs dropped. Error rates dropped. Speed increased by orders of magnitude. And something else happened that rarely gets discussed. The nature of the strategies themselves changed. The machines began identifying patterns and executing approaches that human traders had never conceived of. Not because humans weren't smart enough, but because the patterns existed in datasets too large and too complex for any human mind to hold simultaneously. This is the critical point that separates what's happening now from every previous wave of automation in finance. Previous automation replaced mechanical tasks, data entry, basic calculations, routine processing. What AI is doing now is replacing judgment, the cognitive work, the part that professionals spent entire careers learning to do. And it's replacing it not by mimicking human thinking, but by operating in a way that is fundamentally alien to human cognition. Let me make this concrete, because the distinction matters enormously. A human portfolio manager looks at a company and evaluates it through a framework. They read earnings reports, they assess management quality, they consider macroeconomic conditions and weigh industry trends. A good portfolio manager might track 40 or 50 variables for a single investment decision. An exceptional one might hold 100 variables in their mental model. And they update that model quarterly, maybe monthly if they're unusually diligent. An AI system managing the same portfolio processes tens of thousands of variables simultaneously. It reads every earnings report filed globally, not summaries, the actual filings, all of them, in seconds. It analyzes satellite imagery of retail parking lots to estimate sales figures before they're publicly reported. It processes shipping container data from ports worldwide to predict supply chain disruptions. It monitors sentiment across millions of social media posts, news articles, and analyst communications in dozens of languages in real time. It tracks correlations between currency movements and commodity prices and political developments and weather patterns across every market on Earth simultaneously. And it updates its model continuously. Not quarterly, not daily, constantly. The human portfolio manager isn't competing against a faster version of themselves. They're competing against something that perceives the financial world in a fundamentally different dimension. It's like asking someone with binoculars to compete against a satellite network. The contest isn't close. It was never going to be close. And the professionals who work in these roles know it, even if they can't say it publicly without undermining their own careers. JP Morgan's internal AI system saved the bank an estimated $1.5 billion in a single year through trade execution optimization alone. That figure represents roughly 15,000 full-time employee salaries. One system, 1 year. And that system is already outdated compared to what's currently being tested. This brings me to the thing that I think is genuinely going to reshape how every person watching this interacts with money. Not in a distant theoretical way, practically, in your daily life, within the next few years. The financial industry has always operated with a brutal asymmetry at its center. If you're wealthy, you get access to sophisticated financial management. You get a team, a wealth manager continuously monitoring your portfolio, a tax strategist identifying every deduction and structuring your income to minimize your burden, an estate planner ensuring your assets transfer efficiently, an insurance specialist auditing your coverage annually. That team costs money, usually a percentage of your assets, and the result is that wealthy people's money works dramatically harder than everyone else's money. If you have $5,000 in savings, nobody is optimizing anything for you. You get a savings account paying a rate the bank chose to maximize their margin, not your return. You get a credit card with terms specifically designed to extract maximum revenue from your spending behavior. You get no tax strategy, no portfolio optimization, no insurance audit. You navigate a financial system built by institutions with complete information, while you operate with almost none. And that information asymmetry costs you, consistently, across every financial decision you make for your entire life. AI is about to eliminate that asymmetry. Not reduce it, eliminate it. The concept is called autonomous finance, and I genuinely believe it represents the most significant structural change to the financial system since the invention of modern banking. Here's what it looks like in practice, and I want to be specific because vague descriptions of the future are worthless. Imagine a system, not a single app, but an integrated AI layer that sits across your entire financial life. It connects to your bank accounts, your credit cards, your investment accounts, your insurance policies, your tax records, your mortgage, your subscriptions, every financial relationship you maintain. And it doesn't just display them on a dashboard, it actively, continuously manages them. It notices that your checking account has accumulated $4,200 beyond your typical monthly spending pattern and moves the excess into a higher yield account automatically. It identifies that your car insurance premium is $67 per month higher than a comparable policy with equivalent coverage from a competitor, and initiates a switch on your behalf. It recognizes that you made a charitable donation in March that qualifies for a tax deduction you haven't claimed, and files an amendment. It observes that appreciation in one stock has pushed your portfolio out of its target allocation and rebalances. It detects that your mortgage rate is 1.2 percentage points above current market rates for your credit profile, and begins exploring refinancing options. It notices that you're paying for a streaming subscription you haven't used in 4 months and flags it. It does all of this continuously, silently, proactively, without requiring a single decision from you. Every individual component of this system already exists today. AI-powered robo-advisors manage over $460 billion in assets. AI lending platforms process millions of applications. AI fraud detection systems analyze billions of transactions daily. AI tax software handles increasingly complex filings. What's happening right now is integration, the merging of these individual capabilities into unified, comprehensive platforms. Apple, Google, Amazon, and a wave of fintech companies are building precisely this. The technical barriers are largely solved. What remains are regulatory hurdles and consumer trust barriers, and both are eroding faster than most analysts expected. The second-order effects of this are where the real transformation lives, and this is the part I find most fascinating. When everyone has access to optimized financial management, the efficiency advantages that currently accrue to the wealthy begin to compress. Not disappear. Wealth still generates returns, but the gap in how effectively that wealth is managed narrows dramatically. A person earning $50,000 a year with AI-optimized finances may actually capture a higher percentage of available financial value than a person earning $500,000 a year using a traditional human advisor. Not because they have more money, but because the AI eliminates every point of friction, every missed opportunity, every unnecessary fee, every suboptimal allocation, with a precision that no human team can match, regardless of how much you're paying them. The math on the fee structure alone is staggering. A traditional financial advisor charges between 1% and 2% of your assets annually. That sounds almost negligible. It's not. A 1% annual fee on a $200,000 portfolio over 30 years, assuming 8% average returns, costs you approximately $480,000 in lost compounding. Not $480,000 in fees paid directly, $480,000 in wealth that never existed because the fees reduced your compounding base every single year for 3 decades. Switching to an AI-managed portfolio at 0.25% recovers the vast majority of that. This is potentially the single largest financial decision most people will ever make, and they'll make it not by earning more money or taking more risk, but simply by changing what manages the money they already have. Now, I need to be genuinely honest about what AI in finance cannot do, because the limitations are as important as the capabilities, and ignoring them would make everything I've said less trustworthy, not more. AI systems are trained on historical data. They identify patterns in what has already happened and project those patterns forward. This works extraordinarily well under normal market conditions. It fails, sometimes catastrophically, in genuinely novel situations. The 2008 financial crisis, the COVID crash, the meme stock phenomenon. These were events that shattered historical patterns. AI systems trained on prior data would not have anticipated them, and in some cases would have amplified the damage by executing mechanical responses to anomalous signals at machine speed. There's also the problem of correlated failure. When every major financial institution uses similar AI models, trained on similar data, employing similar strategies, the potential for synchronized collapse increases. If every AI system identifies the same risk at the same millisecond and executes the same cell response simultaneously, the result is a market crash that unfolds faster and more violently than anything in financial history. We've already seen small previews of this. The 2010 flash crash, the 2015 ETF crash. These were algorithmically amplified events that wiped out billions of dollars in minutes. Now multiply the algorithmic participation in markets by 10, and the potential severity scales accordingly. And there's the bias problem, which is more nuanced than either its critics or its defenders typically acknowledge. AI lending models have been shown in peer-reviewed studies from the National Bureau of Economic Research to approve 16% more minority applicants who would have been unfairly rejected by human loan officers. That's a meaningful improvement in fairness. But Apple's credit card algorithm was simultaneously found to offer women dramatically lower credit limits than men, with identical financial profiles. And the engineers who built it couldn't explain why. The system isn't inherently fair or unfair. It reflects whatever biases are embedded in its training data and its architecture. The question isn't whether AI is biased. The question is, who is auditing the bias, how rigorously, and whether those audits have actual enforcement power. These are real risks. They deserve serious regulatory attention and genuine technical solutions, not dismissal. But here's my honest assessment of where this lands. The risks of AI in finance are real and significant. The risks of not adopting AI in finance are larger. The efficiency gains are too substantial, the cost reductions too dramatic, the performance improvements too consistent for the industry to resist this trajectory. Financial institutions that refuse to adopt AI will be outcompeted by those that do. This has already begun. And consumers who don't utilize AI-powered financial tools will be systematically disadvantaged compared to those who do. This isn't ideology, it's arithmetic. And arithmetic doesn't care about anyone's comfort level. What this means practically is straightforward. If you're currently paying a human advisor 1% annually to do what an algorithm does for a quarter of that, you need to understand exactly what value that human is providing that justifies a potential six-figure lifetime cost difference. For some people, there's a genuine answer to that question. Complex estate situations, business ownership transitions, emotional coaching during volatility. But for most people, the honest answer is habit and social pressure, and those are expensive reasons. If you work in finance, the relevant question is not whether AI will affect your role. It will. The question is, which parts of your work involve genuinely human capabilities that AI cannot replicate? Navigating ambiguous ethical situations, managing relationships through crises where trust matters more than optimization, creative problem solving in unprecedented scenarios, communicating complex trade-offs to people who are frightened about their futures. These are real skills. They are also a much smaller portion of most financial professionals' actual daily work than the industry wants to admit. If you're building a financial life, the most important thing you can do right now is understand that the tools available to you today are already dramatically better and cheaper than what existed 5 years ago, and they will be dramatically better and cheaper again 5 years from now. The person who starts using AI-powered financial management at 25 doesn't just save on fees. They benefit from 3 or 4 additional decades of optimized compounding, better tax management, and continuous risk adjustment. The math on early adoption is overwhelming. The financial industry, as it has existed for the past century, was built on a simple premise. Managing money is complicated, and you need expensive professionals to do it for you. AI dismantles that premise completely. It makes sophisticated financial management universally accessible, nearly free, and in many measurable ways, superior to what any human professional can provide. The institutions that understand this are already transforming. The ones that don't are writing their own obituaries in quarterly earnings reports that show declining margins and customer attrition. And the individuals who recognize this shift for what it is, not a threat, but the largest democratization of financial capability in history, are going to build wealth in ways that previous generations literally could not access at any price. The infrastructure of the next financial system is being built right now. The only question worth asking is whether you'll use it.